In this video, I try to explain some concepts related to the macroeconomics. So, to understand the concepts in a very appropriate way, let's go to the first of all from the national income. National income is known as NNP at factor cost is national income. National income is not include transfer payment or the union union payments. Transfer payments are that which are transferred in the form of like pensions and which is circulated as the transfer. National income not includes the transfer payments and the immediate payments. The labor and capital of a country acting upon its natural resources, producing annually a certain amount of net aggregate of commodities, materials and immaterial, including services of all kinds. This is the one of the statement given by the Professor Marshall H.W. Trapp. It is the labor and the capital and of a country that acting upon its natural resources, producing annually a certain amount of net aggregate of commodities, materials, and immaterial, including services of all kinds. So this is the statement of the Professor Marshall. And in the macroeconomics, proxies are used. Output is used in the place of income, and the income is used in the place of output. So when we will discuss in the macroeconomics, so this proxies they are used in the place of each other to get the net from the gross. We depreciate the depreciation. So from the gross, if we minus the depreciation, we get the net. So GDP minus depreciation is NDP is gross. GDP means gross domestic product, where it includes the wear and tear. While we minus depreciation, we get the gross net domestic product. And GDP minus depreciation minus net domestic product plus net factor income from abroad we get the net national product. In the national we includes the net factor income from abroad, whereas in the domestic we not include the net factor income from abroad. So in the product market there are the two things. One is the factor price, another the market price. The factor price is of the production price. Well, remember the calculation are not made on the basis of the market price, but they are made on the basis of the factor price. So remembering that production market price and factor price. Okay, market price includes the factor price plus net indirect taxes. So these are the things, things, two things related to the market price. Factor price, production price, whereas the market price includes the factor price plus net indirect taxes. Let us understand some other things related to this. GDP MP means GDP gross domestic product at market price minus depreciation. We get the net domestic price from the net domestic price at market price. From the gross, if we minus the depreciation, we get the net. Gross minus depreciation equals to net. From the GDP, if we minus the depreciation, we get the NDP. And from the NDP, if we add the net factor income from abroad, means the income which is the which comes to India. If we add, we get the net national product. Net national product, the market price, and in the net national product at market price, if we minus net indirect taxes, we get the national income that known as the net, net national product at factor cost. It is the national income. So first of all, GDP at market cost minus depreciation, we get the net domestic product. GDP minus depreciation, we get the net domestic product. From the net domestic product, if we add net factor income from abroad, we get the net national product at the market cost. From the net national product at market cost, if we minus net indirect taxes, we get the NNP at factor cost, that is the national income. So it is very easily understood. Okay, deflector is the nominal GDP divided by real GDP. Nominal GDP is the current price, whereas the real is base prices into 100 become the GDP deflator. Nominal GDP current price, whereas the real GDP is the base price into 100. Okay, further NNP equals to GNP minus depreciation of the NNP. NNP at factor cost is the value of commodities and services turned out during an accounting year, counted without duplications. Net national product at the factor cost is the value of commodities and services turned out during a financial accounting year without counting duplication. So this one is moving to the next NNP at factor cost or national income. Income minus tax equals to income depreciation. If we minus the taxes, we get the income depreciation. The disposable outlay is the disposable income minus sales, we get the disposable. Okay, coming to the next, real income, money income divided by price index into 100. Real income is equals to real income. Real income equals to money income divided by price index into 100. We get the real income. Real income equals to money income divided by price index into 100. We get the real income. There are the three methods of calculating the national income. Product method, it includes the agricultural, industrial, and the service. Product method is also known as the inventory method. In that MP minus net indirect tax factor cost through the product method. Income method is the NDP at factor cost, whereas in the product method includes the MP minus net indirect tax at the factor cost. It includes in the product method, whereas in the income method NDP at factor cost. Here, income of labor, and the another is the operating surplus things. And in the operating surplus includes the rent to the land, profit to the entrepreneur, and the interest to the money. And that includes the mixed income. Another method is the expenditure method, GDP and Y equals to C plus I plus G plus minus M.